This is not my video. This is Casper SMC, and I think it's a great video that you should watch.
What's up, guys? So I wanted to make a quick video on external and internal liquidity. So to make things really simple, internal liquidity is just going to be a fair value gap, okay? So every fair value gap we have is going to be viewed as internal liquidity. Every single one, right? Now, the market is always going to be moving either from one of these fair value gaps or from a low or a high. The low or highs are going to be external liquidity, right? So here's external liquidity right here. There's going to be external liquidity right here. So remember, the saying will help you kind of remember what you're looking for, and that is IRO to ERO. Now, they should add one that says back to IRO, right? So that's the cycle the market's going in. So basically, the value here is to understand that if the market is traded into one of these, it's likely to move to another. Now, if there isn't a fair value gap, like for example, see how we went from external range liquidity, or we traded into it, and there wasn't a fair value gap, well, we're likely to move to the next point of liquidity. Price is always just going to move from one area of liquidity to the next. Now, in these moves from liquidity to liquidity, you can always look on a lower time frame and look for a market maker model. If you're on the 15-minute, then you're going to look for a 1-minute market maker model. Now, if you're on, like, let's just go from the top down. If you're on the weekly, looking at a weekly fair value gap, you would want to see a 4-hour market maker model from that. Now, we're going to talk about in a second what market maker models are and how to spot them, but for right now, let's just focus on this. So 15-minute, and we'll go through the rest of the time frames. The daily, like if we had a daily fair value gap or daily high or low, we'd use a 1-hour market maker model. If we had a 4-hour point of liquidity, right, whether it's ERL or IRL, we'd use the 15-minute. If we have the 15-minute, we're going to use the 1 hour. Or, I'm sorry, the 1 minute for our lower time frame. So what are we looking for in that lower time frame? What you want to see is at least 3 consolidations, right, moving up into this range with a sharp reversal. So let's draw this out. We have one consolidation down here, right? We have another consolidation right here. We have another small consolidation right here. And then what do we have at the top? We have a reversal. Now, you can plot this reversal in many ways. The first and easiest way is going to be a market structure shift, which is just going to be market structure going from making higher highs and higher lows to lower highs and lower lows, or vice versa, just if you were bullish, right? It's just a change in market structure. Now, some more advanced ways you can do it is going to be looking for SMT. So let's say if we're looking at NQ and the ES had made lower highs, right? Like let's say if this on the ES went like this. Okay, well that would be SMT divergence, right? If the NASDAQ was making a higher high and ES was making a lower high. Another way you can do this is by a change in the state of delivery. So as soon as a series of up close candles is engulfed by down close candles, you could say the market is now trading bearishly. Another way you can do this is by using the specific candle that took out the last little point of liquidity. So like right here, let's say if we have the last candle that closes above that high, when that candle is engulfed, you could look at that as a change in the state of delivery, okay? That also is a manipulation block. That is a term that we went over in the mentorship. It's in week 2 of the mentorship. I also have a YouTube video that goes over this as well. So basically, all of these are just different tools to confirm that you're moving to the other side of the curve. Now, what does that mean? And this is where market maker models really become valuable, because you're looking at that higher time frame level as context, right? This could be a fair value gap or a high or a low, but in this example, it's a fair value gap. So if we're going to be looking for a reversal as fair value gap, we're going to use this market maker model to confirm that. And once we confirm that, like once we confirm that we are on the right side of the curve, meaning we're on the side of the curve that's seeking out that external liquidity. Now, the external liquidity is always going to be, if we look at it on a 15-minute, you can look at it and you'll see, let me drag over here, you'll see that it's the low, right? So if we have this internal liquidity, right, was that fair value gap, and then we have the low right there, that is going to be the external liquidity. So we move from internal to external. We use a lower time frame market maker model to confirm when that's happening, all right? So let's go back to this 1 minute. My internet's loving to be slow today. So we're going to use that lower time frame market maker model to confirm that. Now, once we are on one side of the curve, we're looking at this as the draw on liquidity. And this is how you're going to find draw on liquidity, okay? So once we are on the right side of the curve, or the sell side in this example, since we're seeking out sell side liquidity, it would be different if this was a bullish market maker model. We would be saying we're on the buy side of the curve because we'd be seeking out highs, which is buy side liquidity. When we look at this, as soon as you get that shift, right, whatever you're using, maybe if you use this change in the state of delivery, maybe if you use an inverted fair value gap, right, that's another trick you can use, right? Whatever it is that you're looking for happens, whatever confirmation tool you use, you're just using that to confirm what side of the curve you're on, okay? That's all that is. All this, whether it's SMT, a market structure shift, change in the state of delivery, inverted fair value gap, they're all relatively the same in the sense that you should only be using them in context of a higher time frame move to confirm a change in the overall direction of price. So once that happens and you're on this right side, all you're looking to do is either sell above highs if you're bearish, or you're looking to buy below lows if you're bullish. You can also look at bearish order flow. So for example, any fair value gap or order block can be looked to sell from. So if you look right here, we have an order block, right? This is a last up close candle before a down move. You can see that order block is respected right here and right there. Or if you just want to trace price action, go from order block to order block, right? So we have another order block right there. That is respected. So the market moves down, back in a bearish order flow, down, back in a bearish order flow, down again. And you can look for this to continue, right? And if we see right here, the market continues on that same exact train of thought or same bias the entire time until the draw on liquidity is met. So this is the way to identify, quote, a sell program. It's a term that's used a lot in ICT. It's really just bias, right? Are we bearish right now? If we're bearish, we're going to look to sell from bearish levels, okay? Order blocks and fair value gaps. There are multiple trade entries to be had throughout this kind of move. And at the end of the day, really, this is some of the most valuable stuff that you can understand when it comes to trading ICT. Is exactly what I've taught you in the last 7 minutes. I mean, if you can master this alone can make you a ton of money. So cool. Hopefully this helped. And as always, let me know if you have any questions.
Okay, I hope you appreciated that.